Well, good morning. My name is Ron Cordes, and I am a co-founder, along with my wife Marty, of a family foundation, the Cordes Foundation, in which we have become active impact investors. I'm delighted to be joined by three great panelists this morning for a conversation entitled "A Different Type of Return on Investment." And what we're looking forward to talking about today is catalyzing capital in new and different ways to solve important problems. So I'm joined today by Liesel Pritzker Simmons, Vice President and Program Director of the IDP Foundation here in the U.S., Annie Chen, Chair of the RS Group based in Hong Kong, and Jed Emerson, Executive Vice President of ImpactAssets and the co-author of the recently published book, Impact Investing, which I learned just yesterday was the recipient of a 2012 Nautilus Award.
Oh, wow.
So let me just perhaps frame for a moment what we're going to be talking about, this concept of impact investing. And the way I kind of see it, it fits between two areas that are perhaps more commonly understood and have been practiced for a while. So on the one side is the concept of a recoverable grant or a program-related investment, which are, in my view, both things that fall in the grants portfolio of a foundation, as opposed to sitting on the traditional investment balance sheet. On the other side are the screening of public equities and debt, negative or positive screens, SRI, ESG, vitally important. In fact, I believe all of us are practicing that as part of our portfolio. But what we'd like to share the next hour with you discussing is kind of that part that fits in the middle, which direct investments, where 100% of the dollars related to a particular investment would be directed to solve, with a thesis of change, to solve a particular issue area and achieve a level of financial return. So that's when we talk about impact investing today, that's the direction that we're going to be focused. And we have, with Annie, Liesel, and myself, three individuals who have been actively involved as kind of early adopters in catalyzing and deploying capital on our own portfolios. And with Jed, we have one of the early leaders in the space who for the past decade plus has been writing and speaking about impact investing. And Jed also acts as a strategy advisor to both IDP and RS in implementing their strategies. So what I'd like to do is start with you, Liesel, and have you share with us at IDP, how is it that you began this process of becoming an impact investor? What led you to it? And what are you doing in the space?
So my experience, I'm quite new to this space. I'm kind of at the beginning of my journey towards blending my mission and my investment strategy together. But the way I came at it was actually from the grant-making side. So in 2008, I took a portion of my assets and formed a foundation. And one of the earliest projects that we focused on is a program in Ghana that focuses on low-cost private schools. So our foundation, our mission is towards, we focus on education projects. But also, like all good strategic philanthropists, we're looking for scalable, sustainable solutions. So we thought focusing on this low-cost private school sector would be a good program area for us. So we partnered up, like other good strategic philanthropists tell us to do, with a microfinance organization called Opportunity International and one of their partners in Ghana, Sinapiaba Trust. And what we were particularly focused on and solving was there are all of these sort of mushroom schools that pop up all throughout sub-Saharan Africa and also in Ghana. And they're private schools that are located in very poor communities as an alternative to overcrowded government schools, but also because sometimes there is no government school. And there are over 6,000 of these schools in Ghana. And what we were interested in is, can microfinance institutions lend to these schools, and what kinds of products and services do these types of schools need? So we conducted market research, and we started asking microfinance institutions, why won't you lend to these schools? You're a mission-driven microfinance institution. What's the issue? And they said, oh, schools don't make good loan clients, they're really risky, their educators aren't really very entrepreneurial, all of these barriers. So after doing some research, 3 years later, 15 trips to Ghana later, we developed a program that we've piloted in Ghana with 103 schools, and we have only had one default. So our microfinance partner said, oh my gosh, we can lend to these schools. We didn't realize that there was a market here, but your grant opened up this market. Now we want to scale it up into our normal products and services. And I mean, I can talk about the impact of these loans on, but we see enrollment increases, we see infrastructure increases, we see parent engagement increases, all of these indicators. But essentially, we used our grant money, a $1.3 million grant, to develop a program that an MFI then wanted to scale up within their normal program. So we were quite happy with that. But the thing that I found completely devastating about this was how focused and strategic we've been with our grant making. We absolutely had no mechanism at the foundation to then invest in something like that. We had no mechanism to sort of move up that supply chain and actually invest in these programs that we think are so important to develop. And so I felt that our investment strategy was completely siloed from what we thought was important on our grant making side. And so this was devastating. And so where we're at now with the foundation, but then also with my personal assets, is what is the money trying to accomplish? What is it actually trying to do? And getting away from notions that, I guess, traditional notions of risk and traditional notions of return. And so that kind of was a big wake-up call, and it occurred because of a grant that we made that we deemed successful. So that's where we're at with IDP and with our investments.
Terrific, thank you, thank you. So Annie, you're investing today in a geography that's earlier in the fields of both social enterprise and impact investing in Asia than certainly here in the US or in Europe. So share with us a bit about what is it that kind of prompted and inspired the RS Group to look at impact investing, and how do you look at investing your portfolio?
Okay, thank you, Ron. So I'm from Hong Kong. I started on this journey about 4 years ago, and what prompted it was a restructuring in our family trust in a way that I had to take responsibility for my own portfolio. So the type of capital, if you will, that we're dealing with here is inherited wealth. The origins is inherited wealth, and it's my personal portfolio, and it includes both investment and philanthropic capital. The why behind my engaging in impact investing, in a way, is really a journey of figuring out how I look at wealth and what is my personal relationship with the wealth that's inherited, that's not created by myself. And like Liesel, I kind of started on the philanthropic side. I started by thinking that the simplest thing would be to just give it all away, because I'm not an investor by training. I have not been interested in investing by any means. In our family, there are other family members who are much more professional and interested in investing than I was. But it's been a journey of going from thinking about just giving it all away through philanthropic means to finding a completely different way to create social and environmental value using basically the entire portfolio, whether you call it the investment capital to impact capital to philanthropic capital, using all the tools available to reach the goal of maximizing impact, whether it's environmental or social. And then we need to build in some financial dimension to that as well to make it sustainable. And it's become, the journey has become kind of my own personal pursuit of happiness in a way, in terms of finding meaning in this whole process. and a new way of relating to the assets that I've been lucky enough to receive. But of course, along the way, I got a lot of help, ranging from our family office head, who put me in touch with the idea of responsible investing, going out to find advisors, because in Asia and even in Hong Kong, which although known as a financial hub, is still fairly behind even in the area of sustainable investing. I remember a few years ago when I approached private banks and talked about responsible investing, they kept pushing green funds and water funds at me. And when I asked them, well, do you know what the UN principles of responsible investing are? They kind of just gave me a blank stare and had to go back and do their homework. So I got a lot of help, also along with doing some research and reading and meeting people who are willing to share their experience and knowledge in this space. And so at this point, I'm going to kind of I kind of want to say that because to me, impact investing isn't an asset class. It really is more a way of bringing values and looking for the extra financial value in any investing or grant that I do, and looking at the entire portfolio holistically rather than just using the philanthropic piece to engage in this. That I was joking with Jed yesterday that I'm going to start calling myself a blended value investor, at least at this point. And ultimately what it's about is the integrity across the entire portfolio. If I have certain values I want to bring to bear to the philanthropic activities that I engage in, I think those same values really should be embedded in the investing that I do as well.
Thank you, Annie. So Jed, before we get to Jed to provide kind of some context, I'll share a third story just to give you another perspective of kind of three different ways in which individuals have come into this field. So I was fortunate enough 6 years ago to have built a company with two partners, an investment management firm. We sold it to a global insurance company, and at the time we did that, Marty and I did something that we'd always wanted to do, and that was we formed a family foundation. And we became quickly aware of the fact that there are limitations no matter what the amount of money. We're not the Gates Foundation. We have several less zeros on our balance sheet. So no matter how passionate we were about a particular issue, whether it be an economic empowerment, empowering women and girls, and human rights, which Marty leads the charge in our foundation, we became frustrated with the fact that in the traditional family foundation environment, it was only the 5 or 6 or 7% grants budget that we looked at as the pool of capital available to make change and do good. And as an investor by training in history, I kept looking at that other 93 to 95% and saying, why can't we affect the same level of change with that we're doing out of the 5 to 7%? Early 2007, I decided I'm kind of a go in with both feet, ready, fire, aim type of approach. I decided that what we wanted to do was to see if we could challenge ourselves. So Marty and I went to our board and said, over the next 18 to 24 months, we'd like to put 20% of our portfolio in what at the time we just called social enterprise investing in social enterprises, because the term impact investing had not even been coined yet in 2007. It wasn't part of the lexicon. And I remember telling our board that, and they approved the strategy, that we may lose some money on these, but if we do it, we're going to lose it brilliantly, intelligently, we're going to try to lose it effectively, we're going to try to really learn something from this that will inform not only what we do in the future, but that might also inform what other wealth holders, family foundations, investors do. What's kind of ironic as we think back now, so we became fully invested with that 20% in early 2008. In fact, I think by the time Bear Stearns fell in the spring of 2008, we were 100% invested on our impact portfolio. Now, any of you that happen to have had any involvement in the financial markets in 2008 will remember that wasn't a particularly good year. So we fully expected as we went through 2008 that we'd probably be sitting down and having a somewhat sobering conversation with our board of directors in 2009 about the performance of our impact portfolio. Well, actually, by the time we got to early 2009, the impact investments in our portfolio were our best performers. We'd invested primarily in debt. We'd invested in small, medium enterprises. We'd invested in microbanks throughout the world. In fact, my running joke at the time was that the best investments that we made were in microbanks and companies whose names I couldn't spell nor pronounce, nor could I probably find them on the map, but they completely outperformed the investments that we'd made in all the blue chip brand name companies that had been part of the financial crisis. So what became clear to me as an investor in 2009 was that it is possible to have this double bottom line impact. And then I began to explore, as someone that's been in the financial services space, why aren't more people doing this? Is there actually demand for this among investors? And if so, why isn't more capital being deployed in that direction? One of the reasons I knew intuitively was it was really hard. Deploying that 20% was probably the most difficult process I've been involved with in my 30 years in the investment world because we had no idea where to put the money. In fact, I thought it was going to be relatively easy. In 2007, I hired a team of young MBA students, and I said, give me a landscape of what this market looks like. So unlike some of the things that Liesel has done in direct investing in Ghana, we looked more at a portfolio approach of investing through managers in a series of funds, which is the business that I've been in before, manager of managers. So I thought it'd be relatively simple. Let's go out, let's find all the databases of impact investing managers, let's evaluate their performance, and let's put a portfolio together. Well, after about the first 4 weeks of Google searches, this MBA team came back and said there is no database. In fact, we found 3 or 4 of them, but we have no idea who these impact investment managers even are. Ironically, what we found over the course of our 12-month investment cycle was that the single best source of new impact managers was existing managers, where somebody would say, well, if you're investing with us, you really should consider this other manager because many of the investors with us also invest with he or she. Now, that's a wonderfully collaborative paradigm. And frankly, something that I hadn't seen in 20 years of hedge fund investing once, right? One manager referring to another. And so I thought, what a wonderful collaborative paradigm that's in this space, but how unfortunate that that's the best they can do and that's all they have to rely upon to try to bring investors in. So that led to the formation of an organization, late 2009, early 2010, called ImpactAssets. And ImpactAssets is a nonprofit financial services company. I gave this presentation on Wall Street last week. I had to stop at this point and say it again slowly. Nonprofit financial services company. We're designed with a sustainable revenue model, but at the same time, we're designed with a primary objective of being field builders and catalyzing capital for impact investing. So Jed is involved in our senior team as our Executive Vice President of Strategy. It's really a partnership between our family foundation and the Calvert Foundation with great support from our friends at the Rockefeller Foundation. And one of the things that Rockefeller did as support is they funded an industry study that looked at over 1,000 high net worth investors and asked the question, if you were presented with an opportunity to do good and do well, have this double bottom line in your portfolio, is that something you'd be interested in? And not surprisingly to me, 48% were interested or very interested in learning more. Less than 1% were doing anything. So that really led to, why was there this huge chasm? People are interested, but yet they're not catalyzing capital. And what it came down to was, in a nutshell, that this group deals almost exclusively on their investment portfolios through their financial advisors. And their financial advisors weren't capable, equipped, or interested in having those conversations. So because I came out of that business and have been and worked with financial advisors for 25 years, that was really the touch point for me, where I said, this is a place where perhaps I can add value, which led to us forming ImpactAssets as a way to become the go-to resource for financial advisors. So if you're up on ImpactAssets.org, one of the things you'll find is the ImpactAssets 50, which is the first publicly available database of impact investment managers. We launched it at the Clinton Global Initiative last year. It attempts to solve the problem that we had in 2007, which is if I want to invest and build a portfolio and I want to look at geography and impact area, et cetera, where do I go? Who do I talk to? We have other products that are coming out, but they're all premised on the idea that if we want to catalyze investors, then we need to catalyze their financial advisors and have the gatekeepers open the gates as opposed to keeping them closed. So there's kind of 3 stories of how folks got into impact investing. Now, Jed, I'd like to turn it to you and just kind of share the context. Annie had mentioned one of the themes that you've promoted now for over a decade, of blended value and looking at the overall portfolio approach to impact. and just share how you think about this in the window that you look out of into the space.
Sure. Thanks very much. Well, first off, thanks to Jane and her team for inviting us to have this discussion. I think it's really one of the most exciting conversations that's taking place today, in part because it really is at the intersect between investing and philanthropy. And traditionally, we've thought about the process of value creation on a bifurcated basis. You basically focus on creating financial worth for a portion of your life, and then you turn around and you focus on philanthropic and charitable activities in order to give back, if you will. And I know that one of the entrepreneurs in the Bay Area said that he didn't like thinking about philanthropy because he didn't feel like he ever took anything away. And I think that it's interesting when you think about the number of folks who are coming to the conversation today with more of a blended approach to how they understand the nature of value. That the idea that you would pursue financial returns and performance for the majority of your life, and then spend the last part of your life in some ways making up for all the things you did to create the financial performance, it just doesn't make sense to a lot of folks. And I think that that's part of what's driving this, is fundamentally a different way of understanding the nature of value, the value we create in our professional life and also in our personal life, that you cannot disaggregate the value proposition. I think the second piece that's driving a lot of today's conversation is really a growing realization that no matter what the issue is that you care about and that you're committed to having an effect upon, no matter how much money you have to give away, it's not enough. Right? It's just not enough. Things are moving at a scale and with a momentum and a force today that if you took all of the good grant making that's done in this room today, it's not enough. Tonight, by the time you go to sleep, 27,000 children will have died from preventable disease. The biologist E.O. Wilson says that we are now in a period where annually we are losing 27,000 species of plants and animals on the planet every year. When you think about the forces that are in motion, and then you think about and it's actually not 5% because you're allowed to bill your administrative costs against that if you're a U.S. foundation. So if you think about the 3% that you're basically investing in impact, what business model would you invest in if the entrepreneur came to you and said, I have this great proposition for you. For every dollar that you invest, I'm going to take 3 to 5% and execute my business strategy, and I'm going to take 95% and put it in a CD. Right? Or even worse, I'm going to invest in some of the companies that I actually think are destroying value in the market. This is not a winning business proposition, and I don't think it's a winning philanthropic proposition. And let me just close by saying that I think what's really happening in large part is a revisioning and a re-understanding of fiduciary responsibility and obligation, where you have individuals who are coming to the table and are saying, you know, it's simply not enough to manage our philanthropy as some sort of a private investment group that then does kind of good things on the side. That really the reason that these entities are created is to drive and create public and social and environmental value and impact. So let's manage all of our assets for that end. Now, I know that a lot of folks from the traditional financial services side would say, but you have a fiduciary obligation to maximize financial performance. And I think that we forget that the very concept of fiduciary responsibility has evolved. And indeed, there was a time in New York State where, as a trustee of a New York State endowment, you were not allowed to invest in anything other than, wait for it, bonds issued by the state of New York. Okay? Now, it was not the regulators and the legislators who came to the fiduciaries and said, gosh, we think maybe you should broaden your measure of performance. It was the fiduciaries who went to the regulators and the legislators and said, we have a larger obligation, and we feel that we can pursue that obligation most effectively by broadening the set of investments that we can bring to the table to manage the assets that we're responsible for. In the last 20 years, much of the institutional investor movement that's taken place to consider off-balance sheet risk and liability represented by global climate change has come from the trustee community itself, saying that, in fact, if we're not taking into account these factors, we actually feel we're violating our fiduciary responsibility. And so they have acted then to kind of open the window in terms of our understanding of what it means to be a good fiduciary. And those efforts on the institutional side are really being complemented increasingly by the efforts of people such as the folks on the panel and others certainly around the world who are coming to the table with a new vision of fiduciary responsibility and obligation and what it means to manage assets effectively. And I think that's really, in large part, what this conversation's about.
Well, thank you. To pivot off Jed's comment, I often think about, when I speak about this, the concept of the little pocket and the big pocket. And the way I look at that is that, and I'll use U.S. numbers because that's what I'm most familiar with, but here in the U.S., we're the most philanthropic nation on the planet. So we give away charitably $300 billion a year, individuals, financials, corporations. And we're large players in that space here, and we can see the amazing things that are being done with that money to affect change and to do good. The problem is, to Jed's comment, the problems of the world are so much larger than that small pocket of capital that we're deploying. I look from the investment world at the $37 trillion of total investment capital that we have available here just as individual consumers in America. And what if we were able to deploy, even take a small number aspirationally, 1% of that $37 trillion in the same direction we're putting the $300 billion, that would double the amount that we're putting towards solving big problems. So that's what gets me up in the morning, is how do we get there? How do we begin to develop that paradigm and that philosophy among people, the blended value philosophy that will ultimately lead them to deploy their portfolios in that direction? And I think that we as owners and holders and stewards of philanthropic capital should frankly be the low-hanging fruit, right? We have this mission-driven money, to Jed's point, and why should that money not all ultimately be directed in some way toward addressing the mission areas that we've determined are important for those philanthropic pools of capital? As we prepared, we spent some time preparing over breakfast this morning, and I had a list of questions, and we bantered back and forth, and I asked one particular question, which, for the group, what's been the biggest challenge you've experienced in kind of trying to build an impact investment portfolio and put these investments on the books? And Liesel had an incredibly impassioned answer to that question about some of the work that she's been doing with one of her financial advisor teams. And I'd just love to have you share, from a client to an advisor, how has that role been, and what challenges have you faced, and how have you tried to overcome them?
Well, I think also, I'm new to this space, and I'm a new investor as well. And so at the very beginning of my career as an investor, a devastating economic crisis occurred. And so the thing is when I talk to my financial advisors about, moving assets toward impact and, direct deals in, scary African countries that they don't know how to operate in, I get, what's thrown back at me is, well, that's really, really risky, Liesel. And I'm like, well, you weren't so concerned about that in 2008. I don't understand your assessment of risk, and apparently neither do your compliance people. So, I guess I'm just saying, I think that there are other definitions of risk that need to be put on the table. And, my financial advisors don't necessarily like to hear that. And the thing is I'm not an investor, so I'm still learning as well. But I'm just saying, I've found a very closed-minded view of these things. And when I, go to my quarterly meetings and I look at the graphs that are put in front of me and I look at the standard deviation, there's a lot more to those graphs that aren't on those pieces of paper, both in terms of risk, but also in terms of return. There are a lot of things that those companies are doing that my financial advisors and their managers underneath them don't know about, both from a positive perspective and a negative perspective. And so the first thing that we did was just do a massive screening of everything, good and bad, in the portfolio. What are all these companies actually doing? How risky are they? Are they funding the Sudanese military? Are they, which Volvo is? Volvo! I grew up in a Volvo station wagon. Anyway, so I'm just saying, not in one, but anyway. I'm just saying things that I didn't know that my portfolio were doing. And the gatekeepers to that information are my financial advisors. And so what I think from a client's perspective, I guess, why has it been such an uphill battle to just find out what's going on in my portfolio? Why is this information not expressed to me on a quarterly basis?
Interesting, interesting. When we talk about metrics, and when we talk about, so we talk about a double bottom line return, social, environmental on the one side, financial on the other, and this just dovetails exactly, Liesel, to your point. The financial side's easy, right? We've got all kinds of numbers, and in fact, as someone who's been in the industry for 25 years, we tend in the industry to make it really complicated, right? We have all kinds of different ratios and graphs that we can apply, particularly when performance might not be as good as we would like it to be, so we could put it in an 82-page performance report and maybe have you not understand that you could have done better the last quarter. But that's all very numeric. On the other side, though, is the concept, if we're investing for impact, particularly in private debt and equity, direct investments, how do we measure the impact? And how do we know if we're looking at 3 different investments, which one, we can analyze the financial returns, but which one might have the most demonstrated impact to solve the problem? So what I'd like to do is ask Annie and Jed from kind of 2 different perspectives, and I would call it kind of qualitative and quantitative. So Jed, you've been very involved since the beginning in designing the standards with the Global Impact Investment Network and funded by Rockefeller and other organizations around how do we actually build a standard set that can be applied across the space. And so what I'd like to look at that is aspirationally, moving forward over the next 3 to 5 years and building it. But today, Annie, in your portfolio, as you make an impact investment and then try to look at that social or environmental return, is it actually being achieved? What are some of the strategies and metrics that you look at in doing that?
Okay, I think this is really early stage. I think we've only made some of our investments in within the last 2 years. And a lot of these tend to be rather long-term investments, whether they're funds or direct investments. So we're still learning as we go along. But we're not letting the challenge of having ready-made kind of a framework for measuring impact, we're not letting that stop us from actually taking steps to go ahead and make those investments. And obviously, you need to be somewhat careful about doing it. You know, it's like any investment, it's not. It has to go through a thought process and a screening process. You know, we try to get referrals from people. A lot of our investments are through funds, so we do our due diligence as much as possible. If we need to get professional help, we do. One particular challenge, I think, is that because a lot of the higher impact stuff tend to be direct investments, and they're very demanding in terms of capacity and resources, from doing the due diligence to understanding where the impact is, to understanding their business model. A lot of these are untested. So how do you understand that? I think so far I've been taking more of an approach, particularly in the context of Hong Kong, of being the first one in, even though there may not be a track record, in order to make it easier for these innovative enterprises to talk to other potential investors. So I do understand that it's a kind of risk-taking, but I think it's a positive kind of risk-taking that's needed when the space is still so new.
Terrific. Well, and that's not only in Asia, I would add that in both here in the US and in Europe, that catalytic investor role is incredibly important, because there are a lot of reasons why an investor could say, I'm going to wait 3 years or 5 years or 7 years until this industry evolves further. And I think we all have no doubt that in 5 to 7 years, there's going to be a lot more information available. But to Jed's point, that'll be 5 years that we still will have not deployed capital towards solving problems that need to be addressed today. So Jed, one of the things that you do at ImpactAssets is write a series of issue briefs, which I read. So I'm going to quote one and have you just, in the context of this whole measurement, talk about what's being done in the space, and aspirationally, if we were sitting here 5 years from now, what you might expect to see, and also talk about the concept of firm impact capacity as a way to look at managers without the full data set today and try to understand if indeed they're moving in the right direction.
Well, let me say right up front, I start the first part of my career in social work, and I'm not really a quant guy. I used to like getting $100,000 grants because I could divide it easily between 4 staff positions. It kind of worked well. And so I actually find it a little ironic that I've spent like the last 20 years really being a part of this whole kind of innovation and the metrics discussion. And I think that part of what's intriguing about the current conversation is that what we're really seeing is a coming together of various sets of actors who within their own domains have kind of developed a set of performance metrics and indices that they're finding for current use are lacking. And when I talk about this, what I mean is that when you speak to any CEO or manager of a large commercial enterprise, especially those that are transnational, you hear them talk about an inability to manage because the standard kind of on the balance sheet metrics don't actually capture what they're having to deal with in the markets. So for example, if you're a global for-profit manager and you're not thinking about how AIDS affects your workforce, or you're not considering how water and the use of water in a certain region affects your production capacities, you're going to underperform. You're going to have increasing problems and challenges. And the fact is, the traditional kind of balance sheet metrics don't capture a whole host of issues that today's managers are grappling with on an increasingly on a day-to-day basis that affects real-time financial performance and return. The flip side is that more and more NGOs and people in the development space are recognizing that while qualitative descriptions of impact and performance and return are needed to kind of augment a more quantitative analytic framework, telling stories alone is not enough. That in fact, if you're moving to using a variety of different forms and types of capital, we really have to raise our literacy in the developing world community around how you understand and track performance of financial impact of social and environmental programs. And this is all kind of coming together in these mutually supportive conversations. And the way I think about it is that if you think about this is going to get out there a little bit, but if you think about a light spectrum, you have the visible light or the colors that your eye can see, and the invisible light is gamma rays, X-rays, and everything that kind of falls outside that visible light spectrum. What we have done has been to place most of our confidence in what we can see in the visible light spectrum. And so we have econometrics and numeracy. We basically track things. We have ratios, and we put a great deal of faith in the ratios. And then things happen like in 2008, where all the numbers are correlated going down. And people say, well, wait, this can't happen because the model said this, or the metric was supposed to go in this direction. And there was a betrayal, if you will, of faith in the numeracy that we had built this financial system around. And so I think a lot of the conversation today about metrics is a question of pushing out the boundary of the visible light spectrum and saying, in fact, that you can engage in the quantitative representation of qualitative value and performance, that quantitative metrics needs to be enhanced by other aspects of performance measurement in order to get a full picture of what's happening. And so when we think about the evolution of this, again, it's important that we recognize that these tools, this thinking, these practices are all in motion, and I'm personally really, really comfortable with that. A lot of people seem to think that somehow we should have figured this all out and we should have these really clean Excel spreadsheets that are churning out kind of blended return statements on a daily basis. But if you think about it, at least in the States, in traditional business practice, a lot of the metrics and the frameworks that we take as given today came about after World War II, when a set of accountants and business people and governmental actors kind of came together and said, wow, thank God for the war, because it basically bailed us out from the Great Depression. And the reason the Great Depression happened is that nobody could tell what was happening in this. So we need to figure out GAAP, General Accounting Principles, FASB, the Financial Accounting Standards Board. A whole host of things came into play in the 40s and 50s that really laid the foundation for how we do business. And that all has evolved. If you think about what's traded on the public markets today, 30, 40 years ago, all of your higher listed companies were companies that had hard assets, had factories, had plants, had materials. Today, you go down that same list. It's Microsoft, it's Google, it's soft, intangible value that over time we have figured out how to take into account. That same process is taking place in this conversation. And it's this evolutionary stage. And the work that the Global Impact Investing Network has advanced has been really substantial. They have a whole set of metrics called IRIS, which, Luther, is the International Reporting Impact System or something like that. It's a very spiffy acronym.
We'll just call it IRIS.
Call it IRIS. And what I like about it is that what they did is they said, look, let's not start with this very kind of nebulous discussion about performance and impact. Let's look at what the World Bank, the IFC, what leading foundations, what NGOs, let's look at all the metrics that people have used and tease out what are the core indices that those folks have been running their businesses against. And let's come up with a set of 50 to 100 indicators. And what they did that was especially cool was then they posted all that on a website and they said, what do you think? And they basically facilitated a crowd-based process to vet these metrics. So people could debate, everybody thinks job creation is a good outcome indicator, but what's a job? Is it part-time? Is it 20 hours a week? Is it 40 hours a week with benefits? I mean, and really there's a process of dialing in our assumption about what these metrics are. And I think over time what we'll see is kind of a coming together from the bottom and the top. So IRIS and GEARS are two standards that kind of can be dropped down onto the field. But as Annie was saying, when you go into the street and into the community, you have to do a bottom-up kind of process of exploring performance metrics and measurement because a lot of organizations don't have the capacity to report out on this basis. And so as investors, in the same way that when philanthropy moved from charitable giving to outcome philanthropy, if you will, people have had to begin making investments in the administrative overhead of organizations to build the ability to report and track performance and outcome. This same process is taking place in the impact investing arena so that you're looking at this as simply a part of how you do business. And so more and more of these conversations about metrics will come together because increasingly people are looking for how to understand total performance, not simply did you make the grant, did you feed the person, but how has that life changed? And they want to understand in commercial market terms what's the total value proposition of the company that you're investing in as well. So this all is coming together in a very exciting way.
Great, thank you. We'd like to open it up for questions from the floor. So we've got, I believe, 4 microphones traveling around. We've got one right here. We can get a mic to her.
Thanks so much. All right, I'll just project. Thank you so much. Thank you so much. I'm Donna Katzen. I work with Shared Interest. We do community development work in Southern Africa. Thank you for this incredible panel. I think one thing that you've all 4 of you captured is the excitement of this kind of impact investing and what I think of as catalytic capital. We, in our work, move banks to participate in unlocking capital for small and growing businesses, small farmers, people on the ground that need it most. I would like to ask, because of this incredible ripple effect that you've all 4 talked about, how do you see the role of moving financial institutions, both ranging from the microfinance institutions that you mentioned, Liesel, to the investors in the field, to banks themselves, to further create and multiply this impact?
Well, maybe I'll start with one side, and that is, so I've spent my career working with banks, large insurance firms, large investment firms on kind of on the capital side of the equation. They all move slow. So I would suggest that these organizations get it today. They're hearing from their clients, they're hearing from the financial advisors, it's trickling up. But it's still a very complicated world today financially, and these organizations all have multiple competing priorities. And the challenge is, how do you take this new space and have it become one of the important priorities in the organization? And I'll tell you, there's only one way that that's ultimately going to happen, and that involves the people in this room. And that's all of you talking to your financial advisors about what they can do to help you have this conversation with respect to your portfolio. Because I'm thoroughly convinced after 30 years in this space that if you ask for something, and if an advisor begins to hear that ask from more than one of their clients, they are going to figure out a way to come back with an answer, and it will raise up in the priority at the firm level. I'm curious now to go the other direction, Liesel, on the work that you do with MFIs.
I think from the sort of from the bottom-up standpoint and encouraging local actors to get into this space as well is, I think for banks, it has to be investable. It's got to be a viable business. You know, if we when we were working with our school program, we needed to demonstrate that these schools actually could repay the loans, and what kinds of services could we do so that they could. Otherwise, you know, we can talk until the cows come home about increased enrollment and, you know, better gender parity, but that isn't actually what a bank really cares about. So I think what's important is creating businesses that embed, or encouraging entrepreneurs to create businesses that embed the social value actually into the governance of the business. Because if it's something that's added on or something that looks expensive to an investor, it doesn't have value. So I guess instead of, in our case, we had to respect the values of the bank we were working with in the project design. If we had imposed them to change the way that they look at clients, I don't think we would have had such success. So I think from the ground up standpoint, it's encouraging entrepreneurs to build these ESG goals into the businesses that they create.
Terrific, terrific. We also, there's a little monitor up here. We have a question that's come in on Twitter. This is a groundbreaking moment for me because I'm not on Twitter. So this is the first time I think I've actually read a tweet. So the question on Twitter is a really good one, which is, how do we address the lack of the issue of not enough investable opportunities? And this is something that I get a lot, the idea that, boy, we're catalyzing capital. We're inspiring people in rooms like this to talk to their financial advisors about investing capital in this direction. How do we complete the other side of that circle? Annie, I'd like to ask you, particularly from the perspective that you're coming from a market that has less investable opportunities today than markets we're in. So how do you see that evolving, and how do you see if we're the demand side of the equation and have capital and we're demanding investments, how do you see the supply side ultimately filling that need?
Let me take kind of two aspects of this question. One is, say, in Hong Kong, I think, or in Asia, I think the challenge is for people who want to engage in impact investing to consider at this early stage to put more funding into incubating social enterprises so that there will be a more robust pipeline of these investable opportunities down the road. Because it is early, I think there are probably more opportunities out there than we realize, because I'm sure there are enterprises that don't think of themselves as offering impact investing opportunities. You know, they just think that this is how we operate. So part of it is helping people kind of understand what it is that we're talking about. What are we looking for in terms of the non-financial performance and value creation? The other aspect, again, I want to go back to not letting the lack of these opportunities kind of stop you from taking some action. And related to that is also kind of being aware, if you're the asset owner or the investor, what it is that you're looking for. Because if you say, I'm limiting myself to that sweet spot where I'm meeting both or the double or triple bottom line, right? I want everything. I want the financial, I want the environmental, I want the social. Well, guess what? You know, even in the traditional world, really good investments aren't all over the place, right? So they're going to be a challenge to find and to identify. So from my personal perspective, I've been engaging and really thinking about if I believe in this field, I want to be part of building the field. And so rather than saying, well, I'm going to wait until I find the perfect opportunity before I actually take action, that's not helping to build the field. So we're looking at gaps, we're looking at where we can come in and be helpful, whether by becoming a catalytic investor, or even going a step further in just using our personal influence or using other philanthropic means to help people learn about this sector.
Yeah. No, I think this is a really great point. And the trick about this, and I don't want to sound flip, is that impact investing is not grant making. And the number of times, I've had a conversation recently with a foundation that's focused on early childhood development. And they said, well, we'd love to do some impact investing, but what are you going to invest in early childhood? And I was like, where do you think kids live? How do you think children are raised? They're raised in families and in communities. Of course, you could do an impact wraparound to an early childhood ed strategy. And we need to understand, to your point, that we have to go out and make our opportunities happen. And I think of it as, I'm from Colorado, so I use a lot of Western kind of metaphors. I think of it as fly fishing, right? And I know none of the foundations in this room would fall into this category, but I think a lot of foundations are kind of like trout. And they kind of sit in their spot.
Looking forward to seeing where this one's going.
They sit in their spot and they kind of do this in the current and they wait for something to float by and then they hit, right? And I think impact investors are more about creating their opportunity. They're more like the fisher person who's standing on the shore and you're looking around and you see some shade there and you see a pool there and you try this and you try that, and sometimes you actually fall off the side and you go into a pool of water and you're all soaked and you look stupid for a while, but then you climb back up and you work your way up the stream. And at the end of the day, it's about proactively engaging in your ecosystem and creating the opportunity. And then you bring the opportunity home and you have a great dinner. So this is the idea.
If you'd bet me $50 over breakfast this morning you were going to figure out a way to talk about trout and impact investing, I wouldn't have believed you. So I believe we have time for a couple more questions. Jan. Can we get a microphone to Jan?
A question and a comment, and the question is, as you're talking about connecting the supply, and first of all, thank you for a fabulous panel, but connecting the supply and the demand, would you say a word about possible changes needed in the Security and Exchange Commission in terms of U.S. investing? Because if you're trying to create a private equity fund and you are strictly forbidden from talking about that opportunity, like I couldn't tell you opportunities here in this room, but I'd love to, because you've got to be sure you're talking only to qualified investors. That's really inhibited the growth of these private equity funds. So I'd be interested in your perspectives on that. But I just want to underscore something that you said about early investments. There's a political organization with the name of Emily. Early money is like yeast. And it is so true. And in fact, in the case of the Cordes Family Foundation, you made an investment at an early stage of a fledgling fund. And the fact that you had invested and you're very respected in this field caused others to take a hard look at that fund. So I have experienced this, and I know how profoundly true it is that when you're willing to move out early, the value of that is even greater than your financial contribution and investment. So thank you.
Well, thanks, Jan. So I'll take this one on because I've worked with the SEC for the last 30 years. So it's funny, when I meet with policymakers, particularly here, there's always the discussion of what new laws and regulations, what new things can we do that would really enhance the impact investing field. And I tend to turn that paradigm around a little bit and say, there are existing regulations and structures in place today, well-intentioned, but that are keeping capital from coming in. And so rather than thinking about something new, we should look at ways to relax. So today, just by the paradigm of how this space works, if I'm putting together an impact investing fund, for a whole variety of reasons, if I offer it to U.S. investors, I'm likely going to limit it to what are called qualified clients. And qualified clients need to have $5 million or more of investable capital available. So many foundations in this room would qualify and are probably invested in these types of vehicles. But we talk about the 1%, we're talking now about the 0.01% of American investors who could access that type of product. So there is some good news happening. The jobs bill includes some interesting crowdfunding measures for early stage ventures, but those are very limited to small investments. What we really need is the ability for investors to invest in increments of $5, $10, $25, $50,000 so that we can reach out to that 48% that the survey sponsored by Rockefeller indicated are interested, and actually give them investment vehicles that are of a size that meet their interest. I'm thoroughly convinced that over the next 5 years, spaces like microfinance and others will evolve to the point where we'll have mutual funds and exchange-traded funds and other vehicles. We're not there yet, and I think that absolutely speaks to the point of what Annie said and Jan confirmed, which is that we as the philanthropic community need to be making some of those early investments to build these markets to the point where products can then be created for investors who will follow us, and we'll be creating and helping to create the track records, et cetera. So I'm seeing the time here. We've got room for one more question, and back in the back, I think we've got, I see a hand up right there. Yes, if we could get a mic.
Hi, my name's Simmons. I wear many hats. I'm co-founder of the Day Network. We basically are in plans of doing an agribusiness incubator in my parents' home country of Ghana. And I guess you guys alluded to in terms of looking for ideas to invest in venture capital. We call it deal flow. I went to business school, and a lot of my friends have, a lot of Africans in diaspora have moved back to Ghana, Nigeria, and Kenya. And I look at what's going on in Africa, and I've got a little bit of ambivalence to impact investing, but I would say everybody's looking at investing in Africa or deal flow as like I liken it as a pipeline. Everybody's waiting for the oil to come out, but nobody wants to build a pipeline. In other words, nobody wants to teach basic entrepreneurship to farmers and others. Everybody's looking for all these deal flow. In agriculture, if you've got a great business, if you're a startup SME, you want to scale an idea, there isn't a small business development center, there isn't a community center where you can scale an idea like Silicon Valley. We are focused on agribusiness incubation, utilizing the diaspora to provide mentorship and technical assistance. And I've got all these colleagues, they have all these funds in Africa, and they're telling me, I can't find deal flow. I'm like, well, you guys should invest in the incubator. That's how Silicon Valley became. You see all these companies that come to fruition. That's really what we're doing, and I think that's the model a lot of people here, and that's just something that's interesting.
Great.
You know.
Well, thank you. So I'm going to pose that, Liesel, to you as our final question, and that is, do a lot of work in Africa and do a lot of work with early stage entrepreneurs. Are you seeing signs of hope there with respect to incubators being created and that entrepreneurial energy having capital directed toward it?
Yeah, I mean, I think your comment speaks to that. I think there needs to be more of that. I mean, you do see things. There's a hub in Nairobi. There are these and some social entrepreneurship programs, and just general entrepreneurship programs as well. But there needs to be a lot more of it. I mean, when you look at what happened in Silicon Valley, it wasn't really the VC firms that nurtured all that. It was the angel investors, and that's where I think there's so much capital sitting in this room and amongst our peer group in the philanthropic world that can absolutely, I mean, my goodness, the opportunities are endless, but we need to create better pipelines right here, sort of at the beginning stage of the pipeline, to support business school graduates who want to start businesses in their home countries, to support business school development in those countries as well. You know, fund a chair at a business school in Nairobi. You know, there are lots of ways to do that. But I think that, yeah, people are waiting. They're waiting to see what good companies are already coming out. But we, in the philanthropic space, we care about these communities globally. This is the Global Philanthropy Forum. We should also be caring about the business deal flow in these communities as well.
What a terrific way to close. So I would just like to say thank you to my fellow panelists, Liesel, Annie, and Jed, and thank you to all of you for your time and attention.